So one of the things, I was talking to somebody last night, and this audience is amazing. I was talking to somebody last night, and they said, so how does it work? You just get together and talk. And I said, what I love about this group is there are hundreds of hours of data and research that we're constantly challenged with. We all know where we are. We know what just happened. And I think grounding ourselves in just a few facts to try to figure out what the next 6 months are going to be, because we have founders here trying to run their businesses. Can I raise capital? Are we bouncing straight back from where we were? So very quickly, this chart just tells us, the iron law of investing is interest rates. A 1% change in rates leads to a 15 or 20% change in a multiple. And so the reason multiples have collapsed here for all these businesses is because expectations as to inflation and rates has changed dramatically. I hear a lot of talk about 1999, 2000. So if it's all about rates, let's just look at those two things. We plotted them here together. This is 19 to 22 on the bottom. It shows what rates did. We took them to zero. The Fed is now saying our neutral rate is 2 to 3%, and people are hyperventilating. Look at where we were in 2000. Look at what the cost of capital was in 2000.
Crazy, right?
Right? And so this idea, and by the way, the delta there, right? We went from just above 5 up to 6.5, right? So we're talking about going from 2.5 back to 2.5 or 3. But the big question is, are we going back to 2.5 or 3, or are they behind the curve, lost in the weeds, and we're gonna have to go to 4 to 5 to kill inflation? Well, everybody was saying inflation, inflation is here to stay forever. Remember, when we report on core CPI, it's what happened last month. It is not a forward-looking indicator. So we peaked in core CPI.
Consumer Price Index, explain what it is.
Consumer price, this is the basket of goods and services that we all go out and spend money on. So the Fed is focused on the demand side of the equation. They know they hopped us up on a bunch of Red Bull and cocaine to survive the pandemic. And now...
I thought you were talking about last night for Saks, but keep going. You still haven't said a word all day. Look at you.
Okay, buddy? Anybody got any?
You are so gassed.
We're going to get through it, Saks. We're going to get through it together, okay?
You are so wrecked.
So this chart, we deconstructed 20 bank models to say, what are the components of CPI? How do they differ? The red line's where Goldman thinks we're going. The green line is UBS. I just told you the Fed thinks we'll exit the year at 4. We just decelerated significantly. And when they look at May in June, it's going to be down yet further. And here's why it's going to be down. When the Fed stimulated the economy, all the prices we pay for everything went haywire. Okay, the price for a used car was $20,000 for 10 years. And then just coincidentally, they give us a bunch of Red Bull and the price goes to $29,000. For 2 months in a row, we've had sequential declines. You tell me, is the price of the used car this time next year higher than 29 or lower than 29? It's going to be lower because we're destroying demand by raising interest rates. Same for home prices. So what's plotted here is the home affordability index. Somebody who can afford to pay $1,200 a month in December could afford a $350,000 home. Today can afford a $240,000 home. You tell me, are the number of new home searches on Zillow going up or down? Go run your Google Trends. They're going down because people's ability to buy homes is going down. And then finally, airline tickets, same deal, right? And so when you put that all together, you say, okay, sequentially, month over month, forward looking, this stuff's starting to tip over. If you look at what consumer confidence is, it's the lowest in 10 years. Right? Consumer confidence is a leading indicator of slowing down. So again, everybody on television is telling us about what just happened. It's like the nightly news, big red arrows, inflation going up. This is what's going to happen, and what we all care about is what's going to happen. We destroyed 15 trillion. You said this on Pod 80. We destroyed 15 trillion of household net worth in the last 5 months. So the expected path of household net worth would have taken us from 110 trillion to 125 trillion over the course of the last 2 years. That was the trend we were on. Instead, we got all hopped up and went from 110 to 142, but now we're all the way back to 127. That's what I call on path. on trend. So the Fed has done exactly what it wanted to do. It ruined all the SPACs. It ruined it took all the juice. Sorry. Oh, I did one too. Okay. So it took the juice out of the system. That and consumer confidence tells me forward-looking inflation is rolling. Finally, Bernanke says this morning or over the weekend, he said, ignore what everybody else is saying, follow the tips.
No, we've been saying this since May of last year.
So this is the break even. This is the bond market. When that goes positive, that means the bond market is saying that inflation is rolling over because this is the 10-year less inflation. And so now we have anecdotal information about cars, about houses, about airlines. We have our common sense. We know that those prices are not sustainable, and we have the bond market telling us the same thing. That's why I don't think you should believe the hyperinflation narrative.